Armstrong is Managing Director, Armstrong Investment Managers from the London Stock Exchange. Patrick, is this normal, that type of ratio, the fact they're better at guiding over there?
Yeah, it's typical that American companies meet and beat expectations more than Europe. They're better at massaging their numbers and getting analysts to change their estimates just prior to when they announce the earnings, so it looks as though they've met, even though the revision happened a month or two before they've reported. So that it is typical, but it's also symptomatic of the weak economy within Europe as well.
What do you like right now? What have you liked from what you've seen?
Well, the companies within Europe that have done well are the multinationals. They're doing very well. The luxury brands companies, the LVMHs, L'Oreal's, CF Richemont, the automobile companies are doing very well. It's companies that are stuck selling to European consumers or European industrials and the materials companies that have really suffered and had big negative revisions this year.
And for how much longer do you expect that to continue?
I think we're probably stuck in a bit of a European underperforming other economies. You've seen the US return to growth. Japan's doing very aggressive monetary policies to engineer some growth, and Europe's still really not even addressed the core issues that led to the European crisis. So I don't think we're going to have sustainable growth in Europe. And you really need the ECB to get to do unconventional policies like every other government or every other central bank's been doing. And I think a weak euro will facilitate some growth, but we're not there yet.
On a valuations basis, there must be some good picks in Europe over the US, though, right?
I think that's the most compelling thing about Europe. We were short the STOXX 50 all year up until the big sell-off in June, and we closed our shorts, and it was purely on a valuation basis. Europe's trading about 65% of book value versus book value in the United States. Earnings are about P's 12.5 in Europe and 15, 16 in the US. So you're getting 30% discounts for Europe on a like-for-like on valuation basis.
And right now that's worth it?
I think they should be cheaper, given the other things. I think we don't want to be short Europe anymore, but they are cheaper, but there's good reason why they're cheaper.
What about financials?
Financials is something, I really want to see credit lending before we get into financials. As I said, we've covered our shorts in Europe, so we're not short the banks anymore. But there's still a lot of bad loans that they're not owning up to. I'd like to see a unified banking union across Europe, and that would give me a bit more confidence. But they're cheap. They are showing earnings growth. That's been one of the sectors that has shown some good earnings growth and beaten primarily this year as well.